The rally here is pretty incredible. Pretty incredible. And what's the news? What's going on? Well, to many people's shock, the US and China essentially shook hands. They essentially said, let's pause things for 90 days and let's come to a reasonable middle ground. That offers substantial peace in the realm in terms of global trade. Because let me tell you this, if China is willing to work with the US, the number one rivals, right? Rivals, US and China. If the rivals shake hands, what do you think happens to all of US's allies? If the rivals are shaking hands, you bet your bottom dollar the allies of this nation, the US, are going to step in and make deals. Because if they're making deals with China and you haven't made a deal with the US, a fire has been lit under the proverbial you-know-whats of all the other nations who are not yet this far along in the trade deals. So where are we at? The market says, oh my gosh, we're going higher. That's what the market says. The market says, boom, that's what we needed. Because again, if, people kind of laughed in the face of like, oh, UK deal, that's happening. Haha, that's, we knew that one was going to happen because the US and UK are like best buddies. But then you got China, the number one op to the US, comes in and says, let's make a deal. Up we go. That was the big one. That was the big domino to fall. And instead of the big domino falling, like this is how we kind of all thought trade was going to go. Like this is what we thought. We thought that, the big one was always China. We thought like, okay, UK, we knew that one. India, right? Like we think India's going to, and then we thought like maybe we'll get somewhere with Europe and Japan. No, we actually just saw the biggest domino, China, just fell. And we said, deals are coming. The answer is no, I am not bullish on gold for two reasons. First and foremost, the jobs report kind of killed the bullish score. What I mean by that is that jobs beat expectations in the United States, which hurt the score for gold. Okay. So with jobs report coming in stronger than expected, and inflation, cooling off, that's a positive for gold, but we can actually go look at gold in a closer, detailed view. Gold here, right? Take a look at the bias. We can see it's getting a neutral reading. So trend has flipped bearish. That's a troublesome sign for scoring. Seasonality still positive. Sentiment, people are now kind of flipping more towards bearish sentiment on gold. So that is a positive as well. But we had strong services PMI. We had strong manufacturing PMIs. Retail sales were strong. Inflation data was good for gold because it came down. That's good for gold because it means Fed's going to cut rates more likely. Dollar index may see some weakness, right? But that's not the only thing we look at. That's why we look at the stuff in its entirety. So we see a lot of the metrics here kind of pointing towards mixed to bearish sentiment for gold. So gold for me is exactly what the Edge Finder has oriented. It's a neutral reading. I wouldn't be surprised if we bounce off this level, but I would be surprised if we just ripped through those highs. Like I'd be surprised by that move. To be honest, I would also be surprised if we saw a massive move like this too. So when I say neutral, what I mean is I think like the most likely scenario for gold right now is that it respects support, respects resistance, and maybe just chops around for a while. We'll see. But that's my take on gold at this time. When I get a neutral reading, price action looks kind of mixed. I mean, you are still in a big picture uptrend, but let's not disguise this. We've been in a long-term trend for some time. And if you get this week a decisive move lower, it's possible that gold's kind of day in the sun may actually be kind of due for a true reset, a true pullback, right? We saw that in markets. We're looking at a weekly chart. We saw that this year in markets. We needed this bad, right? We needed a reset kind of move. Many people thought it was going to go much lower, right? We saw a 20% correction in the S&P 500. Typically, that's a buying opportunity. That's what we treated it on this channel as. You saw doom and gloom YouTube get crazy during all this time because people were like, hey, this thing's going down 50%. And maybe it still does. But again, my bias remains to the upside. This is a dip I buy, right? In the last 20 years, that's a time where where everybody freaks out. You actually start looking for opportunities. And so that's pretty much what we've done. Companies like Tesla, I bought a lot of Tesla, and this thing, oh my gosh, it's up. What is that up today? Tesla's up 8% today. Like, this market is ripping.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
8% up for that. Let's take a look at Apple. I bet Apple's up. Yeah, Apple's up 6.2%. That's big for a huge company like that. What about Nvidia? Oh, Nvidia's up 4.38%. Google, which has been struggling here recently, up 3% still. Robinhood, this has been one of my best stocks of the year. Look at Robinhood, up 8% today. What a beast stock. There's another one I wanted to look at. Oh yeah, Delta Airlines. This might be like one of my most impressive percentage trades that I've taken. I pretty much bought this thing. I'm not gonna say I bought at the low, but it was pretty close. And I mean, I'm up pretty nicely on Delta at this time. So we'll see if that can hold its gains or if this market wants to cool off a little bit. But when I look at, S&P, when I look at NASDAQ, I do want to be a buyer of this market. Price action seems to be decisively turning bullish, right? We've got higher lows, higher highs. So those traders are looking bullish. We've got, well, here's maybe something for the bears. Nope, not even for this. The 618 got declined, rejected, right? So sellers probably tried to hold this level. Boom, we broke through that level. Resistance consistently has been taken back from the bears to the bulls. So again, on a technical basis, I think it's kind of a hard thing to defend at this point. And I saw this, I remember in 2020, guys, this was one of the craziest things. One of the most polarized I've ever seen the markets was in 2020 when this thing had just crashed immensely. Everyone had this drawn on this chart. Did anybody else, just curious, did anybody, Lincoln says bears back into hibernation. Yeah. Did anybody else have this drawn on their chart? I'm just curious. 2020 daily chart, Fibonacci retracement from the high of the move to the low of the move. I can't tell you just from memory how many people I saw in the trading world that had this exact chart drawn up. And every time we would take one of these levels, I noticed this was a lesson to me. It was like, sometimes a pullback, you can tell it's not a pullback by the way it reacts to the fibs. So like you had this level get checked, we stopped there, and then we just bulleted through there. Then we did it again. We stopped, and then boom, we shot through it. Came back, retested it, came up to this level, respected it briefly, higher low, boom, we took it out. If you see pullbacks in this type of environment get turned into breakouts, you have to acknowledge that. So take note on a technical basis, when we are looking at the S&P 500 and people are record-breakingly bearish, I'm not making that up. If we take a look at the AAII Investor Sentiment Survey, we've talked about it a lot on the channel. We had 11 straight weeks where people were greater than 50% bearish, okay? The bears were very bearing, okay? And so there was 11 straight weeks. It was a record-setting duration to have a 50% or greater read in the AAII Investor Sentiment Survey for bears. Massive, right? Massive bearishness. And so in this circumstance, right, what do we see happening? We see the ultimate short squeeze. We see all the bears running for the hills, running for the woods, I suppose. They're back to hibernation. And it is like a bull run, if you will. So I think that's where the name comes from, the bull run, right? They're just completely wiping the sweeping the decks with the Bears right now. And well, could that change? Of course it could change. But timing that has been a tricky thing for a lot of people this year. A lot of people have gotten themselves into a lot of trouble trying to say, this is where sellers are going to take over. This is going to be where. Like, maybe they do, but I think the most likely scenario here is that we are probably on to the next story, which we know from the excitement around when we saw the elections going on. The excitement was we're going to get tax cuts and deregulation in corporate America, and that theoretically could boost business profits. And so I think we're possibly on that side of things now. I think we're on the downhill. Like this was the trade dynamic, I think, right? We peaked out in terms of concern, and I think we're like here now. Like I think we're not here. We're not here. I think we're like here. Like a lot of the trade worries are now behind us, at least for now. Okay. Nick's way too bullish on S&P. Oh boy, when he's wrong. And if I'm wrong, I'll take a small loss, right? So like, let's say, and this is where it matters, right? So I am no doubt I've been bullish. Like I've been bullish pretty much this whole time. Like I've not wavered too far. Over here, I was cautious on stocks. And again, you can go look at my videos and streams at that time. I was really watching gold a lot more. And then when it fell initially, I was still watching gold, trading gold, really not paying attention to the indices. I really started getting bullish over here, which was way too early, but ultimately ended up being the right call. So I'm, my cost average between like everything in my stock portfolio is probably around like an average of here. That's just a guess. And so if we see trade-wise an opportunity where NAS pulls back to support and I go long, you say like, oh boy, when he's wrong, like I might be wrong. So I'm not saying, that might be true. You might be wrong, or I might be wrong and this thing might be going lower. If that happens, we manage risk. So what I mean by that is, let's say that this works out and we make a lot of money. That's great, right? But let's always do our research on what happens if I'm wrong. That's always important. I'm going to cut the trade, and full transparency, I'd probably try again at this level. And if that goes wrong, then we move on. But we're not going to risk 10% of the portfolio. That would be silly, right? That would put me in a world of pain if I made those decisions. But I'm talking about probably somewhere in the realm of risking 0.5% on the account, and then maybe 1% on this setup. So I could lose out on like 1.5% to 2%, depending on what the edge finder is scoring. I do have a dynamic risk approach. So my point with this is, like, whenever you have an opinion on markets, someone said this to me a long time ago, and it has stuck with me for a long time, which is basically hold strong opinions loosely. Because everybody on YouTube and Twitter, they have big ideas and big thoughts. Like, clearly I am bullish on the S&P and the NASDAQ and all that, yes. But like, if I'm wrong, I'm not going to get destroyed, right? That's people who are like leveraged up and they're long a bunch of call options, but I don't do that. Are there traders out there who make way more than me and who are, bigger hotshots with options or with like leveraged CFD products? Like, sure, there are people who are, they're probably up like 30% on this move or 50% on this move, or with leverage, they might double their account, calling the bottom and trading. Like, some people might be doing that. That's not me. And I'm not a very like high risk, high reward type trader. I'm a low risk, mediocre returns. And I accept that because I'm working with a larger capital basis. I'm at a phase in my life where I'm married, my tolerance for risk has declined a little bit from when, I first got started, and that's okay to acknowledge. I think I saw something on Twitter. You guys might find this entertaining. Somebody on Twitter I saw said, as soon as I know a trader gets married, I unfollow them because their risk tolerance is no longer there. I thought that was funny. I mean, that's brutally, that's a strong take, but I can respect it. Like, I'm not that guy. Like, I'm not going to be the guy who you get on the channel and I'm like, dude, I've got, 150% leveraged, and then I'm just, I'm all in on the NAS. And, I from my risk tolerance, I have a relatively low risk tolerance if we're just looking at percentages.
But what I do know is that I said yesterday in a meeting that was publicly available for you that it was dollar bullish going into this week. I was a bit uncertain about the day and the time, and I was like, okay, I think we're going to go higher in May, potentially until CPI, and then CPI can tell us if we're going to continue. Lo and behold, and I said, and I probably don't say that too much, but it was, as long as Trump doesn't do anything about tariffs. And sure, hit it. And I believe this reason going higher is because we now believe that CPI in, this is May 12th, so June or July number is going to be higher than expected. Okay? Can't wait for the Lambo when I'm 120. Dragon. All right. I didn't say it took you 120. You need to be 120 until I said if you hold for 100 years, and even if you hold for 10 years, statistically you're supposed to win. You're supposed to make money out of the stock market. How much? Well, I can't tell you that. But what I do know is that most of U.S. U.S. workers are in the S&P 500 somehow, some way, and they seem to be finding that a good investment, and they don't pull out, and they don't freak out. So why shouldn't we? Smart money, we're accumulating dollar for the past 2 weeks too. I would agree with you. 24/7, Warren Buffett was famous for saying that you can't invest for 12 months and you shouldn't trade for 5 minutes or in a day. Also, Warren Buffett is the king, and I really regret seeing his current condition of hold, low debt, legacy, proven companies that is going to be there until we are 120, and that is kind of a company like Coca-Cola. So that's pretty much okay. Question for the swing traders: are you still looking to short dollar or not? I think I can take you on that. Okay, so I am supposed to be the mentor here, right? I'm supposed to be that mentor, right? And supposedly we're supposed to have a meeting like an hour ago or so. And in that same meeting, the theme for the meeting was how to become a better trader, how to become from break-even to profitable trader. And what I said, and what I continue to say, and I've always said, I will continue to say for the next 10 years, is trade what you see, not what you believe. And when you see a market going higher or high, do you then believe we should be selling dollar? And I think the easiest answer to that, if we go to retail positioning. Okay, chat. Before we look, do you think that so number one is, do you think that retail is most short at the moment? Or do you think, and number two, with something down arrow or something, do you think, down is for dollar down and up arrow for dollar up? Do you think that retail, generally speaking, right now as we speak, is positioned buyers or sellers? Retail is short. Dollar just went higher. Retail sentiment says dollar. I need to see it faster. Symbol. No. DXY. Can I double check only dollar? Can I do only dollar? Am I braining myself right now. Okay, let's look at dollar pairs then. Fine, whatever. Indices, commodities. So, mostly buyers, so mostly short on dollar. I was argue in between, and I would argue in between, I would argue in between, and I would argue buying dollar. And I would argue selling. So, averagely, yeah, they're more than anything else, depending short dollar. And dollar just went higher. And that is why that mindset is very, very, very dangerous. Because if there was one, I think it was Yusuf, he said, if I thought that we can close the gap, we can fall down and then close the gap, coming down to 56.61 on S&P 500, and I'm like, no, you cannot do that. And the reason why I want to say that is when we have a higher high, when we have technical higher high, and the reason why we have a higher high is because we have reached a deal. And for that deal to be rectified in the market to go down again, it's either that the deal is gone or that we've hit targets that whatever that sent the market higher is no longer there. Right? Follow what the market is telling you to do. If you believe a certain way, it's all okay. I can't remember. Short version is it's going higher, it hit target, it can turn lower. Look for technical reasons. Look for technical setups. Look for a reason. Look for whatever is in your reasoning. But currently we're bullish. We are higher high. We have seasonality going higher in dollar. Everything in the dollar bullishness is going for it. Wait for it to turn around. Okay. Thumbs up. Yeah, and I believe too that we are dollar buyers is short term, and it can even turn around on Wednesday when CPI comes around. But I just don't want us to have a belief that something can turn around 180 degree when something just made it go even higher. You know what I mean? Protect ourselves, because I've been in that theory of whoa, we're going lower now. Okay, let's buy it. Let's going into a buy season and look for it to go higher. Yes, possible, and it's possible for your dollar to go to 119. Sure, go ahead. Great, but what is the reasons and what is the drivers? And I've always said this to you guys. What is the driver of the market is always going to be the paramount. And right now it has been the tariffs. Tariffs are still going to be there, okay, for at least the next few days. And then it's going to die out. And there's going to be other reasons. And there's always going to be a crisis. So in the big scheme of things here, what have you learned from these tariffs? Because it's going to come back and kick you in the leg, and it's going to make you fall into the dirt yet again. Okay? What did you learn from this situation? Did you trade profitably? I've seen people like Maxi. I can call out your name because you're a good dude. Been insanely profitable lately. Everything smack. Everything is great. Everything is great. Everything is great. Whatever it is, everything is great. He's one of those who's in my DM sending me his chart setups, everything. Fantastic. I love it. Doesn't need to be more than that. Right? Your dollar to 109, I 100% agree with you. That's totally possible. But as I said earlier in the meeting, I said, let's look for evidence, not what we believe. So we have a low, but we're currently at weekly target on a Monday. That generally tells me we're going to go higher before falling again. And That's just money flow.
Looks like we have a little bit of progress happening on the U.S.-China side. I saw last night that it was going to be a 3 a.m. Eastern Time announcement from Scott Bessent, and there's your 3 a.m. announcement. So Aussie up, dollar up, CAD up, New Zealand sideways. Dollar's leading the charge right now. Currencies have opened up quite a bit at 3 a.m. You got Japanese yen way weaker and the Swiss way weaker. Euro pound in the middle. So interesting, explosion of volatility today. We had 3 to 4% gaps in the indexes. Futures market took a huge rip. Take a look at, today's price action is actually pretty sweet. It was pretty easy sell side this morning, just grabbing a few bucks out of the kind of the market. Shocked. Wow, we're up 3%. I mean, everyone's sitting here like the S&P is killing it today. It's like, well, intraday hasn't done anything. It was just all gapped up from futures. If you look at the futures feed last night, it was essentially all happening at 3 a.m. Eastern time. So this was a gap open on probably some optimism, and then there's your official announcement at 3 a.m. So I look at that as, if you're already in, if you bought the gap and you're waiting, that's tough to trade. It's one candle. There's been a little bit of follow through. Let me go down to like a 1 minute chart. I don't think you really got any of that trade. If you try to trade the 3 a.m. candle, look at that thing. That's a 1 minute candle on the futures market. So you would have already been in just based on sideways movement. That's around 6 p.m. Eastern time all the way to 3 in the morning. So you got a couple points. We're literally talking about 54 to about 68, about 14 points on ES, and then just one massive candle to the upside. So that 3 a.m. announcement is pretty much what put us in to our current price. Candle closes here, current price is right here, like within just a couple of points. So pretty wild stuff. I'm pretty happy that away from the all-time highs. So we're still X amount from the all-time highs. We're still about 5.5% from all-time highs, and I've just crossed highs for the year by about 40 grand. So I'm curious, if this is going to be just an island gap. Is there something that's going to fill this week? We still have CPI data coming out on Tuesday, I believe. So Tuesday, May 13th, here's the CPI news coming out tomorrow morning out of the US. It's going to be all CPI numbers. I thought was kind of interesting. So the previous core CPI was 2.8, and it's forecasted for tomorrow to be 2.8. The previous year over year was 2.4, and it's forecasted to be 2.4. So taking a look at Trueflation, we've still been trending lower, which is not a bad thing. But as with everything else, there is going to be a backfill in this move. Judging by, let's just zoom in here on a smaller time frame. Judging by the way this market is gapped, even in the futures market, we've got some huge gaps. So that's an obvious gap right there. This one is still like a tiny little sliver gap. Gap here and gap here. Now I do see these gap opportunities as buying dips, like buying the dip. It could be back down here towards the 5,700 zone now. This whole thing with US and China, it's been another 90-day window. The US has backpedaled from a 145 down to 30. I think China backpedaled from a 125 down to 10, and the market's loving it, right? It's going to take months, if not years, to really ink and officially, make a trade deal. But the market is just like completely moving on headlines. It's completely moving on headlines. So anyway, if there's some profit taking, expect there to be some gap filling. I still would like to be buying some dips in this area between about 5,500 or so. I'd say about 5,600 to 5,400. I kind of look at this as an opportunity to find some gaps. The one thing that I find a little concerning is what is happening to U.S. yields. Okay, U.S. 10-year yield is still higher, like exploding higher, actually. So we're back up to, I mean, we're up 32 basis points since the first of the month. And this, I mean, whether you pay attention to this or not, look, if we break this high or we come back to this high, I mean, this Liberation Day announcement was what kind of broke the U.S. bond market, right? If you look at the 20-year yield, if we get back up towards 5% of this 20-year yield, something is probably going to happen. Like, that was what made Trump and co. flinch with a 90-day pause, because we saw just yields move like crazy. That was the basis trade blowing up. And I mean, I guess if we're lucky, we're just going to see it kind of chop around in here. But I have real concerns if the 20-year is over 5%. I have even greater concerns if the 10-year is going to 5%, because we were there in 2023. So I think this ultimately chokes off growth. I mean, this might be exciting, like, oh, the markets are on their way to all-time highs. Like, yeah, maybe they are. But a reality check is coming down the road at some point. So I shared this. Let me see if I can find the screenshot. I did this on YouTube last week. I talked about kind of this paradigm A, B, and C. Is it this one? Yep. So I had a YouTube video. This is the thumbnail if you look for it on my channel. But paradigm A, B, and C, and I'll just kind of explain these really quickly. So this is somebody I follow pretty closely on the macro side, Darius Dale of 42 Macro. Paradigm A was the Biden administration. Paradigm B is coming in with Trump, trade war, flexing muscles, recalibrating the entire global trade picture, and obviously making it America First policies. Paradigm B broke. Like, the Trump administration was broke. They flinched, and we saw the basis trade break. We saw the bond market break. And it wasn't a break per se, but it was definitely it was like cut hard. And that was the instant flinch of, hey, we're going to do a 90-day pause, and it just gave the whole world a little sigh of relief. So paradigm C is, we've talked about this, the K-shaped recovery was since COVID, right? So the haves and have-nots. If you have assets, you do very well. If you don't have assets, you deal with higher prices and getting left behind. K-shaped recovery, right? That was paradigm A under Biden. Wealthy people did very well. The 1%, the 10%, those that have investments, those that have assets did extremely well during the Biden administration. Okay. B was supposed to be change this, okay, close the gap and create more of a E-shaped recovery where we can level things off and improve. So instead of having, the lower end get hurt worse and suffer more, it's like we're going to try to create some improvements to inefficiencies, right? So you narrow, Main Street, Wall Street a little bit. Well, that was the pain in Wall Street that Trump and co were talking about. There's going to be short-term pain for long-term gain, but with the basis trade, with the bond market, snapping the way that it did, it really showed how fragile the entire system is. And so I think this got pivoted to now maybe something like this, if we're lucky. It's just been angled up. So those that have still have more and still do well. I think this is going to be potentially put us up into another bubble. I think we're truly seeing that the Trump administration doesn't want to see more pain in the stock market. They saw it once, they tried it, it didn't work, it backpedaled or backfired, so they backpedaled, and here we are watching the markets up, 20% off the lows. And I think if we break to all-time highs with momentum, we're going to face another bubble. Just like we've had since 2018 to now, we've had all these highs and lows and all these highs and lows. We've had 7 pullbacks in 7 years of 20% or more. It hasn't been every year, but like we've had 7 total pullbacks of 20% or more in the last 7 years. So I think these bubbles are just getting, they just swell more, they happen faster. Obviously, people have been conditioned to buy the dip for a long time. But point is, it's just stuff you need to be aware of, like bigger picture. I think there are concerns. I mean, I think if we get to all-time highs, I'm sure it's going to be celebrated, right? If we get to all-time highs, I'm not going to sit here and say like I'm calling the top, calling the top, call the top. I think that's crazy. But I just want us to be aware that there's got to be a way to measure out like some type of move where, okay, if this thing runs, let's say, connect the dots at the highs, right? So we have resistance here, and we run up into, resistance again. It's like, can we get to 6,800? Can we get to 7,000? Sure. But after this stretch move, it's like, well, are we talking about a 40, 50, 60% move from the upside? Let's just say we go from the April lows to 7,000. That's a 45% move, right? Let's say that happens in like the next 12 months. I mean, it's just wild amounts of volatility. But does that mean we have to top out at 7,000? Not necessarily. I don't know. I mean, honestly, I almost think it'd be easier to not have to trade a freaking bubble and see this market crash. And it's like, well, we're going to have a broadening pattern. And we have, a 45% rally and then a 50% drop or something insane like that. I'd almost rather see this market figure out where reality is, because it's not like right now is not reality. Whatever's happening right now is not reality. All this is self-inflicted wound, all this soft data that has yet to become hard data. The market's not pricing in all these bad things, US slowdowns, like market's not pricing in any of this stuff in yet. Earnings have been fine. Buybacks are as high as they've been since like 1984. I mean, so look, money's still going to the system. The narrative on the trade war has been much improved. So at least right now, because we just poked the highs, it's like, okay, well, I see a dip. If we get a dip like this would be a reality check. That's fine. A little dip that we can buy and then justify participating at all-time highs. Okay, cool.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.